Hi, my name is Eric Zaunscherb. I'm the chair of Critical Elements Lithium, ticker CRE on the Venture Exchange. Critical Elements is the owner of the Rose project in ELEC.V, Quebec. It is one of the most advanced hard rock lithium projects globally, and we are primed to move forward, shovel ready this summer. We're in the process of putting together the project financing for the company, and we are also re-accelerating exploration, as indicated by some recent excellent results in a new discovery at Rose West.
Hi, my name is Lynch, and I'm the CEO of Power Nickel. Power Nickel is advancing the high-grade nickel sulfide project at Nemaska, just down the road from my friend and partner and shareholder Eric in Nemaska, Quebec. And yesterday we announced an amazing discovery of a serious material, copper PGM gold zone called the Lion Zone that is going to add a second element to our story. That super high grade project that's near surface. That's really quite startling. So look for a lot more good news on that shortly.
I'm Brendan Yurik, the CEO of Electric Royalties. We are a royalty company focused exclusively on clean energy metals. And we're closing a transaction imminently that will basically take us up to 40 royalties in our portfolio, diversified across 9 different clean energy metals, along with 31 properties that are already optioned out to third parties that we'd hope to become royalties in the near future. And so, yeah, lots of good stuff coming this year. We've had a ton of developments over the last 24 months, over $500 million raised by operators. That's all going into our assets to develop them at no cost to us. And we expect a lot more of that to come here in 2024.
Brilliant, guys. Thanks for joining us. We're talking about battery metals today. I think something which people expected to really kind of take off last year didn't quite get there. Specifically today, we're going to be looking at the lithium thematic, the nickel thematic. I think Terry's going to go polymetallic on us. And Brennan, you can probably reach across most of those metals too. So, Eric, let me start with you. I mean, lithium went on a run until the end of 2022, came off dramatically last year. People are unsure how to read this very nascent industry of lithium. Is it going to make a comeback?
In my opinion, absolutely. We're already seeing a bottoming of the market in terms of the spot that everyone follows, even though that spot lithium pricing is not representative of what goes on in the market. That's better represented by the realized prices of the producers, and recently some auction prices that have seen a huge differential from the 800 or 900 per ton that in the spot market is quoted at versus the auctions coming in at 1,200, 1,300 per ton. So there's quite a differential there. Definitely more representative of the market. People see headlines in North America and Europe about EV sales being down. Well, the reality is that in the first quarter, we saw globally EV sales up 21%, clearly driven by the Chinese market, which is up 31%, but very, very dramatic increases in EV purchases and consequently in lithium demand. In the meantime, we've seen a massive cutback in lithium supply. Canaccord Genuity is estimating that around 236,000 tons of LCE, lithium carbonate equivalent, have been pulled out of the market from that period of 24 to 27. So a big pullback there on low prices, and we'll see what happens as prices respond.
Okay, and yeah, interesting time. So certainly in terms of OEM, it feels perception of whether OEMs are now continue to be fully committed to that battery revolution. Terry, talk to us about the nickel market. I know you're going to your project, and we'll have time to talk about the other metals, but nickel specifically. Is it going to be okay? It followed a very similar run to lithium last year.
Yeah, for sure. I mean, again, I think the key takeaway in nickel is it's a very differentiated market. So you have Asian nickel, European nickel, and North American nickel, and we can see different markets for each. Asian nickel has obviously been impacted dramatically by the massive Indonesian supply that's hit the market and obviously reduced prices and has kicked out a lot of high cost current operating nickel mines who couldn't make a living with the spot the way it was. So that's had a serious short-term impact and created a lot of headlines for explorers like Power Nickel, who are not in the current nickel market, who are basically going to be in the nickel market in like 29 or 30, of little consequence other than the sentiment. And then you can see, with the deal that Samsung did with Canada Nickel that basically their perspective is that North American nickel is worth a lot more, because you have to have either North American nickel mine content or manufactured content in your EV if you want to get the tax credits through the IRA. So that really protects that market somewhat. I don't think the consumers or investors truly understand that. And that's a good thing for investors so they can take advantage of it.
Okay, Brendan, you have to cover kind of most of these metals. You've got a royalty company which is battery metal focused. What effect has China got on both these guys' companies and commodities? Lithium and nickel seem heavily influenced by China. How do we get away from that?
Yeah, that's a good question. China's definitely been dominating this space. And in the case of Indonesia nickel, they've been investing billions of dollars there over the last 10 years. So this isn't something that just happened overnight. I think the Chinese government definitely has a lot more foresight and can act in a different way than you see politicians in Canada and the United States and Europe for sure. So I think we need to see some kind of change at that level, some type of government support for the sector on similar terms to what China does, for their companies. In the terms of lithium, I mean, China's definitely been the leader in processing of lithium for the last 10 years as well. I don't remember exactly what the percentage is, but it's a very high percentage of lithium that they process, still even as of today. But there is a lot of lithium in Canada and even in the U.S. I think for us, especially hard rock deposits in Ontario, Quebec, could be a fantastic source of lithium. That could be an entire industry. But when you look at the actual capital going to that space, it's very, very minimal. Almost none of it's going to exploration, despite, explorers having a lot of success. There's a lot of spodumene targets right at surface sitting there and tested in Ontario. And I think there's enough lithium there to really, fill any supply gaps that we have if you committed the funds to companies that need it there. And we had the support of government, like China does, I'm sure, back home as well. So, I mean, there are things we can do, and there are deposits, especially for those two metals, here in North America, that could be great sources of supply. But definitely, we need a little bit more support. And China's been very good about doing that on their end.
Eric, tell me how you feel about China and how you play this. Lithium, very technical metal. Most projects are very unique in a meaningful way. You're not getting the support that you need necessarily from government upstream. Downstream, yeah, but upstream, not so much. It feels like, is it possible to do business ex-China?
And it is possible. I would say that one of the biggest challenges, and I'm sure Terry can go into this, has been the naked shorting question about the markets in Canada. But I think that there's another huge problem that we have in Canada, and that's the availability of capital, and that Brendan introduced there. If you look at it, if the numbers are to be believed, we're looking at around 4% of funds in the pension funds and other funds in Canada are allocated to Canada, let alone mining. And it used to be 70% of the money that was raised for exploration and development globally went through Toronto and Vancouver. That's been cut way back. Look at what Australia's done. A comparable figure for them is around 20% of the funds in Australia are available for Australian companies. And that's the huge differentiating factor between us and Canada, where we used to be, where we are today, and what our competitors, in particular Australia, are doing. The comparable number for us for China is, as Brendan alluded to, is we're seeing a lot of money that's being spent by the Chinese to make things happen in their own country and elsewhere. So they're going to Africa to pick up some direct shipping ore and that sort of thing. Their lepidolite deposits in the country are not sustainable. Neither are the DSO deposits in Africa. So we need to step in there. We need to have the capital. Otherwise, if we don't find the support within Canada, foreign actors are going to come over and pick our bones.
If they're not already doing so, one has to say. I mean, Terry, you talk about, generally the juniors talk about funding difficulties, being cash strapped and so on, but you've, I guess, raised awareness of another financial burden. It's hard enough competing with the Chinese, competing globally with, or even with your peers, but naked shorting. Tell us about that.
Yeah, it's a real problem, and we found some sinister new sort of information that's so startling that I think it's so bad it's good, because we've now basically determined that one of the weapons the shorters have been using, unbeknownst to us, we always thought the bots were a problem, the trading robots that are the algos that can sort of trade from one a bank to another bank, but we assumed they had the same rules as us, i.e. they had to sort of sell their stock and they had to deliver the paper just like everyone else. But no, as it turns out, they're able to trade under what's called a short market exempt status. So that means that these trading bots have substantially different rights than the ordinary investor, even the ordinary mutual fund or pension fund. So as a result, we've seen that sector of the market go up to 10% of volume, which in any particular market is huge. And in a small micro cap under $1 billion market, it can be mammoth. We're talking the overall volume. So it's a significant problem. We've identified it now. We did not know as an industry this existed, I would say, until 6 or 8 weeks ago when we exposed it. And now that we have, we're actively, aggressively, as an industry, dealing with it head on, dealing with the governments, creating a big lobbying force to change it. So I'm of the view that, well, obviously it's dark out there right now. It's about to get less dark. And like I said to people in Vancouver at the resource conference there, I said the best move in any market is when you're going from bad to less bad. And I think we're going to go from bad to less bad in these markets. So the Power Nickels of the world, the Electric Royalties of the world, the CRE.Vs of the world are going to bounce up just because they've been so oversold and so devastated, anywhere close to their normal value, that it's going to bounce, in my view. And you want to be there for that bounce. And if you can't stomach the individual stocks, then look at the funds, because there's a lot of great funds out there. CI, McKinsey, BT Global, Palace Capital. There's lots of great fund investors that have done well over the years. And the people, I say to the people that are listening, the hardest thing to do as an investor is when you watch a deal that you've looked at and you sort of said, hey, I liked, Eric, and I liked CRE, and I liked that deal. And then I just watched it double. And that thing can go another 10 bagger beyond that. That's what we all believe. But if you miss the double, you never have the courage to get back in. At least I've never been able to do that because it's just too painful psychologically. So I'm saying to people, don't miss that first bounce. If you can't get in the individual stocks, and we get that the charts suck and we understand that whole thing, get into the funds. So at least you're getting part of the ride. That'll help your psychology in terms of investing. Because if you miss these moves, you're really going to be sorry. Yep.
And we're trading at about the same range. And as a royalty company, that's definitely a big discount to where we should be, about 80% discount. I definitely think things are going to turn around. I think if you look at the growth picture for all these metals, it's not just electric vehicles, but it's energy storage. And I think energy storage is really just starting to take off. And I think of that's like batteries for cities,
Yeah,
if you think
sure.
about how much metal those things are going to need, you look at renewable energy keeps increasing globally. All of the renewable energy technologies require, a big variety of clean energy metals like zinc, that it didn't before. So, I think the demand side is actually very, very strong, over the next 10-year, 20-year picture. And to be a mining company or invest in the mining space, you kind of have to have a bit longer term view on where things are going to go. But I think that's pretty definitive. And then on the supply side for a lot of these metals, it's always going to be harder to bring mines into production than people think. So it's always going to be a bit of a delay. There's going to be mines that come off, when prices come down, and that's always a good, solution for prices coming back up. But the supply side is very, very weak across a lot of these metals. I'd say, for the 9 that we target, copper, I don't know where the world's going to find more copper, especially with big mines like Cobre Panama, being taken offline. Tin is the exact same way. For most of the metals that we target, I think the supply side is equally as much a case for, why the space is going to definitely have a bounce here in the near future.
Well, Terry's going to give us some new copper with his new discovery.
I am.
That's news, hot off the press, folks. And Terry, you'll be all over the media, I'm sure, on that one. But just sticking
some headlines
to this conversation for now, which is around trying to get people comfortable with the fact that the demand is there, the need is there, the supply isn't. And what do we do? But we've just come off of, not come off of, we're kind of still there, but it seems to be there's green shoots, so there's rays of sunshine, so we can look forward to light at the end of the tunnel, whatever cliche you want to throw at this thing. But it's been 3 tough years for junior miners, for lots and lots of different reasons, not just because of COVID and economic woes and printing of money and supply chain issues, but because the money dried up. The money dried up. Some CEOs have said, "Oh, the system's broken. The junior mining funding is broken. We need to find a solution." And they started looking at different and alternative ways of funding. Some were able to do that, most were not. But they also looked at different business models to see if that changed anyone's mind. And I think on the whole, that didn't really work either. So can you talk to me, Eric, about the kind of the psychological games at play during the last 3 years for you guys, and what you are looking forward to now? How do you play it going forward? I'm looking for the leverage here, not the woes of what poor me, look what happened in the last 3 years, really. But give me a sense of those conversations, those thought processes.
Sure. I mean, one of the advantages we have as a lithium company is that we have management that's been in the lithium game for decades. Our president, Stefan Aber, and VP Finance, Marcus Brune, were instrumental in building up Rockwood Lithium, which was then sold to Albemarle for $6.2 billion US a few years back. So they've been through these cycles. They've seen what can happen, and they've got the ability to pivot. And so speaking of pivots, we've had to pivot, where our business model before was to get the debt side in place, get an off-taker in place that would also contribute equity. The reality is, as share price collapses and you get down to that 0.1, 0.15 times NAV, you're not going to dilute your shareholders at 0.1, 0.15 times NAV. So you have to pivot, and you have to talk to those parties that instead are more interested in buying a 10, 20, 30% interest in a mine for something that's closer to 0.5, 0.6 times NAV. So that is the shift in the business model that's occurred in our minds over the past year. Yes, it means delaying how long it takes to get a deal in place to put that mine into production, but it avoids that shareholder dilution. The other point is, by delaying, we've seen what happens to companies that have started to build, that have commitments from the banks and off-takers at a certain price or at a certain discount rate. The next thing you know, gee, I'm sorry, but the goalposts have shifted. We're going to have to make you go out to the equity markets and raise another X $100 million at a heinous valuation in order to finish building. So personally, I'm very glad we haven't been building through this downdraft in the lithium pricing. I'd rather be building in an updraft, which we hope is going to be or has already commenced.
Yeah, I mean, I just came back from Dubai and South Korea, and in Dubai, I was meeting with our CVMR, who was doing the feasibility study on NISC, and their project financing approach is completely different. They're doing a lot of stuff with countries, like they do a lot of stuff with the UAE, and they're looking very heavily into tokenization. This is not like a conversation. This is like massive investments that have already gotten into this. I believe that they'll become, I think the UAE and Saudi will become a major player in that space. That'll be a bit of a game changer for us here. They will be players in the venture side of the market. They're going to be players in the product side of the market, the actual projects. That's my perspective. So I think, where we're going with it is, as we advance through the exploration process, and we deliver, feasibility results, et cetera, we'll be able to go back to, clients in Korea and elsewhere to make deals that, basically allow us to, with the government investment, finance out so that we can move forward. We might, we could easily see ourselves in a situation where we're building the refinery before we build the mine. This type of thing. So we're looking at all avenues in terms of how you can advance this in this capital-starved market. But there are pockets of capital, still lots of capital out there. You just have to finance it in a way that makes sense for them. And then for us, obviously, I mean, it's better to be lucky than good. Honestly, we've had this amazing discovery, which the world will soon learn about, and that's going to give us a totally different valuation approach that will, that'll be a different game changer for us. So that may give us some other tools as well. So I think that's the key is to keep nimble. And I know because I know CRE.V very well. Obviously, they're one of my big shareholders and we're partners, and they've always been very frugal. And we're very frugal at Power Nickel. And I think the message has been, if you're looking, and I'm sure Brendan's the same way because I've spent time with Brendan, I know this, those are the guys that you want to bet with, the guys who respect the capital that they fought very hard to get and are spending it well and moving and making progress even in a very difficult environment. Because when the markets turn, those guys are going to blast into the gates, and that's who you want to be with.
And Brendan, for you, in terms of optionality, you've got to take a long-term view on these things. The royalty game is built like that. But at the same time, it's been a tough 3 years for even the royalty companies in terms of that. If I talk to Eric, talk to Terry, they probably have the potential to bring in a strategic investor, right, at asset level for it as one of their options. For you guys, what were your options on the table? Did you look at them? What did you have to rethink how you viewed the market?
Yeah, well, first, just let me say, I think for me, at the very beginning of starting this company, the first 10 years of my career in the mining space basically taught me that mining is a very risky game. And so I don't know if I'd play it out any other way than being a royalty company. We're now going to be diversified across 71 assets, 9 different clean energy metals. We're not on the hook for development costs, capital costs, any of that stuff. So I think it's just a much different way to invest in the space. We've been pretty lucky. I mean, I'm happy with what we've been able to do over the last, 3-4 years since we went public. It's been super tough in the markets. We've only raised about 10 million equity to date. And then we've been leaning very heavily on our largest shareholder who, thankfully has been a godsend to us. He's basically put 10 million aside for us, which we've been drawing down over the last kind of year and a half to continue to add deals and continue to grow despite this tough market. For us also, it's kind of nice. We're 9 different clean energy metals. They all don't go up or down at the same time. And so we've just been able to kind of transition into metals that are out of favor this year, but we know are coming back, the year after or the year after that. So, we've been able to kind of keep growing and just keep adding assets. We're extremely frugal. Like Terry and Eric sound like they are as well. And so, just trying to use that money to grow wisely. And we're pretty pleased with what we've been able to do the last couple of years. I know despite it being very tough. And I really admire Eric and Terry. I would not want to be in charge of exploration or developer this last couple of years. It's been very tough for funding.
It's very tough. It has been very, very tough indeed. And I'm just wondering, this is probably maybe the fun bit of the conversation, and maybe you can impart some of your wisdom, knowledge of certainly the past 3 years and possibly longer. Because when I look back at some of the themes, some of the things we were told to focus on, and I think about it now, I'm not so sure perhaps that with hindsight, I would have done those things. So things like, for me, a big major issue being made out of ESG as for me, looking back, is like, well, perhaps that was a little bit over the top. Good companies do the things that ESG is made up of, but to make companies, spend the time, money, and effort and admin on just, signing those things up, it just felt quite onerous for some companies, and some CEOs fed that back to me. Some US-focused companies fed that back to me. Funding, etc. So I've got a long list, but for Eric, for you, if you sort of look back, maybe not just the last 3 years, but if you look back over recent times, what lessons have you learned? What would you do differently?
What would I do differently? Well, I know what I would do despite what's happened. And you mentioned ESG. I think that you're right that there was some overdoing of that from the perspective of the creation of massive funds that were focused entirely on ESG. The reality is a company that has diversity, a company that looks after the environment and that looks after the local community is going to do better than the other companies. So ESG is inherent to being successful. And we've been very proud of the diversity that we've created on the board and in our employee stack, the relationship we have with the CRE. We formed an IBA back in 2019, the Picatow Agreement, that's been very successful. And the CRE consequently are excited to see us move forward. In the terms of governance, you have to have good governance. So if you don't, you're in trouble. So I wouldn't change that any. I guess given the stock has gone from, almost $3 down to 60, 70 cents, suggests that we should have taken more money back when. But of course, it's very difficult to predict that lithium pricing would come off 80%. And so, yeah, sure, it would have taken more money at that close to $3 than today. What else would we do different? Exploration. I mean, Terry and Brendan have complimented us for being frugal. Yes, I mean, we raised, $30 million in November 21, and we haven't raised a penny since. We've been able to move forward with the project on that basis. Would I love to take some charity flow through right now? Not at these prices, but would I love to take some more charity flow through and accelerate drilling? Absolutely. But there are times when exploration, it doesn't matter what result is, the market does nothing. It views it as a liquidity event and sells off anyway. Oh, do I still own some of that stuff? So, I think we're coming back into a market where exploration is important. That is something that we look forward to, is re-accelerating exploration and demonstrating the potential of over 1,000 square kilometers in that highly prospective area.
Yeah, honestly, there's not a lot of regrets. We've tried to execute, with the capital we had. We've been pretty diligent about using, as Eric mentioned, the exciting 2-for-1 programs you get in Quebec. We've been able to, I think we've been one of the leaders in that. We've raised, money at 2 and 3 times our share price, and means a lot less dilution for our shareholders, and we were able to put the money in the ground, and obviously we have made serious advancements on that side of things. So, obviously would have liked to have had more. As Eric said, war chest would be, I wish it was, a bit more full, but honestly, we got to the point now where we've got some significant, assays that are going to be coming out that will be, in my view, game changers, and should radically reprice the thing, and then obviously it'll bring in a pile of warrants and options, and obviously set us up for. I mean, there's going to be a lot of industry interest in what we're doing on that copper PGM gold play. We obviously got an industry with the nickel thing, so I think we recognize, as a small guy, you got to work with industry, soon, and get them in. You don't want them dictating, but you probably want them participating, and because it helps you in many ways. It gives you obviously access to expertise that already have, and bench strength that you can't possibly replace. And then, of course, it gives you credibility in the marketplace when you're talking to other investors. So I think we've tried to keep that in mind as we step forward, and we'll keep that certainly in our focus.
Okay, Brendan, I'm going to just change the question slightly for you, okay? Because I assume you're going to say the same thing.
Well, actually, I was just going to say going public. That would be my only regret. Yeah, well, we had to, because I look at the valuations on
there you go.
royalty sales,
I love that.
Private space. And yeah, they're going at, multiples of us, right?
I didn't know that. I didn't know that was an option, Brendan.
Yeah.
The point of the question is to say, well, what can other people learn in terms of their investing strategies and so forth, rather than personal regrets or personal, considerations. Because Brendan, when I ask it to you slightly different, if you guys want to pop in after Brendan's answer, that'd be fine. Which is. And I'm going to assume that, similar, maybe don't go public or raise money at a more opportune moment, time the market perfectly like we all want to do. But if you look at some of the messaging and some of the narratives that have been out there, I named one. The ESG narrative was slightly irritating as for some of the reasons Eric said, these massive funds rebranding themselves as an exercise, marketing exercise, but not actually really understanding or caring, quite frankly, in a very meaningful way. Is what were those things that the market was telling? Oh, you must do this, you must behave like that, you must think like this. That you just thought, I'm not quite sure why, but everyone's going along with it, so maybe there's something in it. But now with hindsight, you're like, geez, well, what on earth was that about?
Yeah, well, I'm almost always contrarian. So I think I'm almost always against, what people think you should do right now, because we're kind of looking at, we're going to get a good deal because things are the way they are right now. And then, use our forecast of where we see things coming, knowing that value is going to come back. I don't really have any regrets and stuff in terms of where we've played and what we've done investing wise. We've been really careful personally to stay away from competing with the other big funds. So, all the private equity funds really can't touch anything that's below PFS, pre-feasibility study. So we've gotten a lot of really good deals at the PEA stage where you can basically tell, 90% of the project's going to look like it at PFS. It might have some infill drilling needed. But we've been very, good about staying away from the competition. And then, we are the first group that ever did a graphite royalty financing. We did the second and third tin royalty financings. We were one of the first groups out there doing lithium royalties. So, we got in early and we had very little competition on all these metals. So we've been pretty happy that we put together this portfolio. Like I said, we're going to be up to 71 assets now, since going public just over 4 years ago. So we're incredibly excited about that. But we've been very careful about where we, compete with other capital, and what kind of projects we go after. We've been, again, our business plan is built around looking for those deposits in North America, Europe, and Australia. So we're sticking to safe jurisdictions already. So we didn't get hit by any of the stuff that's going on in Latin America right now. And so I think a lot of the stuff that we built into our business plan has really helped keep us out of some of these issues. In ESG, for example, we do a lot of projects in Canada, United States, where they already have really good regulations. So a lot of that's already kind of built into it. And then just trying to keep things, if there's renewable energy, renewable power source, all that stuff is good. But we never really built up our team so much that it became a big capital burden on us in any way.
Okay. Sorry for the noise.
I know that's not helpful for investors trying to navigate the space, because we just we don't really have any regrets personally on what we did.
I guess for me, one of the things that annoyed me was like economists trying to forecast the future, because pick an economist, you got a different point of view. No one understands that, but trying to put themselves up as experts and saying that they
all
can,
the banks
and then
too,
forgetting
right?
that they did.
If you look at the metal price forecasts, those are the best, right? You go look at the historic metal price forecast by the banks and see how wrong they were.
It's a joke.
Yeah,
it's absolutely. We did it recently with nickel, which Terry might appreciate. You take the kind of top four producers of this content, which is then reproduced by the banks themselves. They don't even have original data. And you see just how wrong the banks are as a result, because they don't have anyone on the ground. No one goes to China and or Indonesia or Philippines checks the nickel numbers, maybe except Macquarie. So yeah, those are the kind of things that annoy me. So what I say to investors is, have multiple sources and then sort of form a consensus view. Might help you a little bit. Or even better, just be a fundamentalist and say, has this team got a decent management team? Is the asset, does it look like it could be something that could get into production at some point in the future? And then you can take a slightly contrarian view, to use your point, Brendan. But I'm sure we'll argue violently for or against whatever we each think or use as an investing strategy. But ladies and gentlemen, I think we're sort of that time of the day where I'm going to ask you each to give us a couple of minutes on your companies. I just want you to ask just a direct question. Why on earth should anyone invest in your company? Eric, go for it.
Okay, as we discussed, lithium is poised, I think. We're seeing the bottom of pricing right now. And in the past, we've seen as the lithium market turns, we see a turn in the equity sentiments. As I mentioned, we're trading at around 0.1, 0.15 times NAV on one of the most advanced projects that this summer will be shovel ready. So that's a great entry point. We've got one of the highest purity low iron oxide and low mica projects globally, which makes it amenable for use in the glass and ceramics industry. And why that is important is because it's a premium product and you attract about 100% premium for that product, which has a huge impact on your margin. We've got a strong relationship with our CRE partners, formalized relationship with the IBA, as I mentioned, signed in 2019. It's one of the most advanced projects with the key environmental permits in place. And we've got strong lithium industry. experience in the management group, again, as I mentioned before. And that's a key differentiator from a lot of the companies out there. And finally, we've had an intentional strategy to avoid offtake agreements. We don't think that these offtake agreements are worth that much, that worth the paper that they're written on. The important thing is to bring some sort of partnership into the mix at a project level that assists on the technical side, and that's also a potential source of equity. So we're at a great point right now, and that's why I think that this is a great entry point for critical elements.
Yeah, I think for Power Nickel, it's pretty simple. We were an amazingly undervalued high grade nickel story before we made this impressive copper gold PGM discovery. Now, this discovery, as it will unfold as the assays come out, is a category killer. It's really going to be impressive. And I understand that sounds hyperbolic to say that, but the assays will sort of prove this out, and it's really one of a kind. So the most exciting time in a investment in a junior miner is when it's going through an explosive growth curve on the exploration side, when they're hitting it with the drill bit. Boom, we're hitting it with the drill bit. And by the way, your downside is zero because, or relatively speaking, in my mind, because we've already got the benchmark of a killer nickel deal that we've got industry participating on that's doing a feasibility study. So it's like you're shooting fish in the barrel here, folks. Doesn't get any better.
Yeah, so we're definitely undervalued where we're at today. I mean, we have some royalties in our portfolio like Battery Hill. We expect that's going to pay out over $7 million a year for 50 years. And here our valuation is less than 30 million Canadian. So I definitely think we're an undervalued company right now. We've got a lot of good news that should be coming out this year. There's 4 different royalties in our portfolio, which could come back into production this year. We've got our Middle Tennessee Zinc Mine royalty. They're basically doing some drilling, upgrading their germanium gallium recovery unit. And then we'd expect that to come back online as zinc prices recover. We've got our Panuda tin mine in Spain, which is really Europe's only producing tin mine. They've been shut down since November over some permitting stuff, but we're hoping to get some good news on that in the near future. And then Piedmont just came out just this last week, said their JV with Sayona Mining, which we have a royalty on their Oche project. They are planning to fully ramp that up in 2024. And so that would mean they'd start blending ore from the Oche project. And then Groffmata, those guys are looking for a strategic investor, basically bring that back into production. Did operate for about 18 months continuously, shut down before COVID. And then with this latest deal, we're going to have some option payments coming in from our portfolio as well. So we're really hoping that we're going to be cash flow positive here, ahead of the end of the year. And we've got access to another, $4 million or so between cash and undrawn on our facility to keep going doing some more deals. So, G&A is very low. We're diversified across 9 clean energy metals and 71 different assets. So I think at our current valuation, definitely a safe play to get exposure to the entire space.
Gentlemen, thank you for your time.
Great to hear.
Thank you.
Cheers.